we'll begin. Thank you everyone for joining us in Athena Blockchain's webinar for strategies for asset-backed token issuers. Let me start by just giving you a little bit of introduction to Athena Blockchain. I'm Eric Gravengaard, one of the founders of Athena Bitcoin. We've been in the Bitcoin space for the last 4 years. Athena Bitcoin primarily serves retail clients, small businesses looking to purchase Bitcoin. Our new offering is called Athena Blockchain, and it's a full-service investment bank for the blockchain. We are pretty strong believers that in the next decade, blockchain-based tokens, whether that's a Ethereum token, a new blockchain, or some other form of a digital currency, is going to come to dominate all other forms of capital raises. So all of the private placements that are happening right now, and even some of the public stock issuances, are going to be replaced by blockchain-based tokens. Not because they can be high-frequency traded like stocks are on the NASDAQ, but because that's a form that dominates all others in terms of convenience for both the issuer and the investor. Some of the things that we are working on building is then investment research, token issuance, advisory. We have an existing sales and trading and asset management business that we are going to be bringing into more tokens and out of just the pure Bitcoin space. Here's a couple of the reasons why we think that blockchain is going to come to dominate new issues. Primarily, it has to do with both who can access it and from both the issuer perspective and the investor perspective. So any stage company can issue a token, whether that's a seed stage company or an established post-revenue company. They can all issue their own token, whether that be a utility token or an equity token. And we'll get into a little bit of the differences of those and then focus more on the asset-backed space. Obviously, when you're talking about a token on an open blockchain, you also have to talk about how individual investors can participate, because they're not bound by the same gatekeepers that keep them out of private placements or venture capital raises, or certainly individuals can't participate alongside banks in most transactions. Obviously, a token comes with a different liquidity than you would get out of a private placement or a Reg D security. That liquidity is more akin to what you might find in the public markets, although not always, because there's no guarantee that there is another buyer, just because you can transfer your token to someone else. Obviously, we've seen token raises over the last few months. Well, the early half of 2017 was certainly dominated by enormous raises, raises that I think probably don't make sense in retrospect, but certainly investors were very eager to get in on some of these token raises, and so some of them, have amounted to hundreds of millions of dollars. We've also seen token raises that were successful for companies where they may have only raised $500,000, and I think the ability to shift and sort of use the same methodology for both big and small raises has been really powerful. And then obviously, you can't talk about tokens without talking about the fact that they are a global phenomenon and open to anyone, both on the issuance side as well as on the investment side. And that's a phenomenal democratization of the, especially of the startup and technology spaces, which up till now have been fairly well, geographically constrained to, 10 or 12 zip codes in the Bay Area, maybe 1 or 2 zip codes in Manhattan, and the River North District in Chicago were probably the only places that got any serious amounts of technology venture capital. I should sit. You can't see me. Paula wants me to sit. She's gonna be embarrassed I said that. So let me move towards just talking about in general what is an asset-backed token. When we talk about asset-backed tokens, I'm talking about smart contracts issued on a blockchain, and that blockchain could be the Ethereum network. It could be Bitcoin with a technology like Counterparty, but the smart contract is a programmatic embodiment of a legal contract. You're still going to be dealing with legal contracts that can be enforced through the court system, but the smart contract can express some of the common actions or functions, such as the transfer of ownership from one party to another, the payment of dividends, payment of coupon, other types of coupon payments to the correct registered owners. When you talk about a traditional asset-backed security, you might be talking about maybe 100 investors, probably usually fewer. It was probably syndicated out to 4 to 10 banks who might get the issue out to their clients. The transfer of ownership is going to be recorded on a bunch of spreadsheets, and so when you have to go pay these coupon payments, it's not that complicated to find out who everyone is and where to send their funds. When you talk about a token, however, now you might be dealing with thousands, tens of thousands, I think eventually hundreds of thousands of investors. You'll want the smart contract to keep a record of who owns the token and where those dividend and coupon payments should go. And that's one of the great things about smart contracts. And then what we'll be talking about today is sort of where you can go beyond just the basics of did I switch it to the wrong button? And you can talk. I mean,
who's this being presented?
Many people, but
okay.
Your note anyway. And then when we think about smart contracts and where we can extend the functionality of those into the future, we can think about other protocols we might want to add on top of just the the basics of a token. The other way we think about smart contracts and tokenization of assets is thinking about a holding company that might own the assets, whether that's a portfolio of natural resource licenses, bonds, various other types of traditional securities. The main concept here is just that we want to be able to package assets that are either performing, non-performing, into some vehicle and to get that vehicle out to investors via a token. So the first example of this that I want to talk about is ZARA. I might be mispronouncing that. My background's not in Eastern European languages. They were originally issued on the Blackcoin proof of stake network. They've recently done a recapitalization on the Ethereum network, mostly so that they can get more liquidity for their token as Ethereum tokens became more of a standard over the last 12 to 18 months. They're backed by presently 129 kilograms of gold. At current market prices, that puts it at about $5.3 million. You can, to use the language of ZARA, you can melt your ZARA tokens and receive London bullion market equivalent gold, from many different dealers. I don't think they have that many people melting their tokens just yet, but it is at least fungible in that way. what I will say about the form that this token takes, is that it's a virtual private currency. Owning the token does not grant you ownership of a company. It doesn't grant you ownership of the gold. It's just a promise that this company, the ZARA company, will redeem your token for gold in the future. It's a service agreement. They can modify that service agreement at any time. You have very little recourse if they were to modify it. So I would say caveat emptor in terms of whether or not this is the type of investment you want when you want to invest in gold. That said, they're one of the more successful tokens that is backed by a physical commodity. They hold the physical commodity at Loomis, which is an international armored carrier. At present, the market cap on this token is about $23 million. Part of the reason for that discrepancy between the underlying value of the gold and the value of this token is that it's every time you transfer this token, you have to essentially burn some of it. I'm sure they have some minting mining word that I'm supposed to use for that, but I can't remember what it is. And by burning your tokens, there are now fewer tokens outstanding for the same amount of gold. And so if you hold these things long enough, you can be the last person standing and own all of the gold. So it's an interesting concept in terms of an asset-backed security. It's not a great way of paying another person just because you are essentially getting rid of value every time you transfer it. There's 3,000 people that hold it right now, but that's an example of some of the types of things that people are trying to launch on the Ethereum network. This project happens to have been around for several years, operating mostly, originally on the black coin market. So now I'd like to introduce our featured speaker today, Neil Benedict. Neil and I have known each other for a few months now. He has a long career in traditional finance, having worked at several large clearing firms here in Chicago. And more recently, he has been doing some work for BANKEX. And I will let Neil explain what BANKEX is.
Sure. So BANKEX is developing a proof of asset protocol, which sounds a lot fancier than what it really is. They're basically a B2B business that specializes in tokenizing physical assets onto blockchains. I'll try to run through a few examples so that makes a little bit more sense. So this is a diagram that our developers put together that I don't really like to use too much, but I think it can be good to run through it just a couple of times. So at the top row, so if you're looking horizontally, a lot of this information for the specifications for these smart contracts will come from the asset owners or the originators of the contract. So you might have somebody who wants to mine lithium or titanium and they need to build the mine. They have rights to the metals. And so they start inputting the specifications for how they'd like to raise the money. That would be this smart contract one column. So this can just be almost like rolling or nested contracts within one another, and each contract can have any number of variables or constraints. So if you go to the second column and you want to one good way to look at the second column would be that if you want to, so blockchain provides an automatic and immutable way to track and audit the state of the contract or the location of the token or the ownership of the asset. So something that's really going to become big as the Internet of Things picks up is tracking the state of the assets themselves. So in that smart contract 2 column, an example would be lithium can be in the initial state, unprocessed and not ready for sale. but it's out of the ground. And then you can have sensors or machinery that actually tests the metal, provides its status back to the blockchain, and feeds it into so smart contract 2 will trigger the verification of the lithium being out of the ground in this example by communicating with the machines and with the provider. So the actual verification box at the very bottom to the far left, that would be maybe employees or somebody running a machine at the mine. And then the Internet of Things would be something you can't tamper with, a machine that will independently verify the state of the metals. And then obviously if you keep going, this can just turn into a super complicated architecture for something more complicated than mining. I'm going to move on to some actual real world use cases we're working on. So the next 2 slides are going to be the same use case. We're working on 2 versions of the same use case for 2 different companies, but they're talking to one another. So what this is film companies will raise essentially a private equity fund. 75% might be debt, and then 25% will be equity, rights to the actual profits from the films being produced. And what they want to do now is issue tokens. So typically in the United States, what they would do is they find their group of producers or their group of investors who've already invested in a lot of films. And it's essentially a closed, smaller group of people who know exactly what they want to invest in. What they want to do now, these same producers who have a lot of experience, they've already made successful movies, they want to contribute their expertise to the project and raise pooled funds, special investment vehicles, exactly like they already are doing with accredited investors in the United States, but issuing these digital tokens where these would be accessible to anybody across the globe. Anybody can see the ownership at any time. And then theoretically, their goal would be that these tokens appreciate in value as production proceeds, as these films start generating revenues. And then this gives some of the investors a quicker way out if they want to transfer that risk to somebody else. These are more liquid instruments than having, your subscription document in paper form at your lawyer's office. But it still represents the full legal right to the future revenues from these films, or in the case of the mezzanine debt, to the interest and principal payments. Their end goal, which is going to be a lot more complicated, is to have a platform where these are pseudo utility tokens where hundreds of thousands of people can buy the tokens for Ethereum or Bitcoin. The cryptocurrencies are held in escrow to fund films, but they're directed to the films of the user's choice. So I buy a membership and I contribute and I buy my tokens, and then I actually read through the biographies of the film crew, the script maybe, who's produced, who is willing to direct the film, the plot, and then I decide which film I want to invest in. So film 1 could be a comedy, film 2 could be a horror movie. This could be anything, but this model is a little more complicated because it doesn't give the producers control, but they think this is what the future of film will look like. It would be crowdfunding. So a young director right out of college writes a script and he thinks it's great. He thinks he can make this film, but he needs a platform where he can host the details of the project and find investors for it. It's just a crowdfunding model where they have the actual individuals investing will eventually have end rights to some segment of the film revenues, or to the repayment of the debt, if that's how the...
No, I can only imagine that this is going to mean that we only watch superhero movies.
Yeah, so this is...
and everyone's going to pretend like they can act like Harvey Weinstein.
Yeah, so
Sounds horrible.
Yeah, so I actually tried to talk them out of wanting... This is what everybody wants. They want people coming to them with film ideas, hosting it on their network, and having everybody decide what they want to watch. So, okay, this one is for a self-directed IRA where they have a lot of privately held small to mid-sized companies who sell their shares to investors who want to direct their IRA that way. So instead of having your IRA in an index fund, you have it in an actual company that, I don't know, it could be a recycling company in Chicago that is doing a very small raise. But the way they want this to work is they want the entire process to be digital. So the subscription docs would be hosted digitally. When somebody signs the subdoc, they would generate their signature, which generates their private key, which essentially does everything you would do on paper but through the API. And the end benefit to this would just be the liquidity of these tokens. The same thing that we've been talking about, that if somebody wants to sell their shares in this company to somebody in India, they can do it in a few minutes without too much trouble. This one is actually getting fairly complicated in real life, but it's a good example of something you can do for any privately held company. So if you eliminate the custodian in this case, well, actually, this is what ICOs are. A small company wants to raise private capital, and in this case, or in a lot of cases, they don't actually give up equity ownership. But one model is that you could give up equity ownership, and that's what this would be, where you host private placements on a blockchain. Everybody can track where the tokens go. And then, oh yeah, so something I should probably mention, whenever we're talking about private ownership, there might be some concern for privacy if you're just listening to this for the first time. You can actually store hashes of the data, and you can generate new wallets for the same user, such that if you have a high net worth individual who buys a large stake in a private company and he doesn't want someone to keep seeing that address accumulating these tokens, you can generate n number of addresses by the tokens in separate transactions, and this can all be built into some privacy function in the API. So the next one is a multi-family construction development project out of Hong Kong. And what they want to do is, there's a developer building a residential tower, if you will. I think it's going to be around 100 units. And the bank is going to finance a construction line of credit, so a non-revolving line of credit where they can draw upon it to build the building. But what they can do here, or what the bank plans to do, is have an API where users can sign up, and this is a twofold benefit here. One is totally unrelated to tokens, where the bank just wants to market mortgages to people for this building. And then the tokenization benefit here is that the developer can input the specifications, so the square footage, the number of bedrooms, number of bathrooms, the normal specifications you put in, say, Zillow or Redfin, but they can put these in a smart contract, set the price for it, just like they would pre-sell these on Zillow. And then the investors can buy these. Now, where this increases the liquidity is that speculators, so not the developers, but somebody with excess capital, say in China, well, China has capital restrictions, but somewhere where they'll buy, let's say, 2 or 3 of these units, they have the full legal ownership tracked on the blockchain, and now they can exchange these as they choose, as the construction progresses. Maybe housing prices are going up and they don't know if they'll be sustained at that level. They can start marketing these tokens to the end users who may live there. You can hold the tokens and rent them out. Another variation that I didn't include in this slide would be they also want to, we didn't build the architecture out for this yet, but at the end of this project, they also want to build a smart office building. So the same building, but the tokens would actually represent physical square footage in sort of an open concept office space, where, say, you could rent the conference room hourly. So like there's a bunch of different users, and they're sort of like the WeWork office concept, but renting month to month, almost in real time, for certain things like conference rooms, event halls.
Neil, what kind of instrumentation would a developer want to build into his building so that it could feed back into like a smart contract for this type of a project? Obviously, as we're constructing it, there's probably, well, I was going to say there's probably not a lot of good sensors, but there's probably a ton of sensors when you're building projects. How many loads of concrete have come in?
Yeah, exactly. So we're still
boards, things like that.
We're still really like in the early stages of actually utilizing a lot of the Internet of Things concepts. But I guess concrete's a good example. So they already have smart pallets with RFID tracking and temperature tracking. So you might say, we didn't do this, but you might build into the smart contract that if n number of, I'm making this up, but if n number of smart pallets show up weighing X amount of concrete, as that concrete is unloaded, it might provide some sort of progress tracking in the smart contract saying this much concrete is being used up. It could have some sort of waste estimate of what amount isn't being, right. So these are all things that are sort of, this is so early for projects like this.
Right.
It's sort of up to us to decide how to track these things. But yeah, so concrete would be a good example. You could have smart, so like sort of a random example, but my water company just installed a smart meter. So as these smart meters are hooked up and the water is hitting the check valve, it could say that, okay, floor 1, water complete, floor 2, water, and as this progresses, so now the end token holders can track almost in real time some of the development on this building. The bank can track how far they are along construction.
Right.
So banks actually have, so I've done real estate lending, and banks will actually send a person out there. So the construction company says, we need $100,000 to build room 1. That's a horrible example, but we go out and check after we send the money that they built it, that the developer just didn't take the money and buy a house, and he's running out of the country. So as we build out these sensors, that will be another use. The bank will track it, the end users will track it. If they fund a mortgage through here, the bank will know right away that the construction company, the developer, has the money to pay down the loan.
Okay.
If they're not, they can have some sort of trigger to lock that section of the funds.
Right.
With the end goal being that
the idea wouldn't be that, oh, we don't need any people anymore, but it might be, as part of this contract, yeah, we're sending, a guy gets sent by some issuer of these tokens. He writes a report, and that report then gets uploaded and attached, put into the smart contract so that investors can track these things in the same way that the bank tracks these things.
Exactly, yeah. So,
but we just separated out the bank's oversight functionality from the capital.
Sure. Yep. Exactly.
Okay.
Yeah. So this is a very hard to follow diagram, so in some respects, but this is just the first iteration of what will eventually be the final agreement on how this project will be carried out.
One of the things that's always fascinated me about the BANKEX protocol was that it is really complicated, because they are really trying to think through what it means to verify an asset exists, verify that it continues to exist, that it produces what it's supposed to produce.
Sure. So it gets even more complicated as the assets become more complicated, like a residential building that's not completed yet. That's why I brought up the metal example, because BANKEX's very first, before I even joined them, their very first use case was gold. Not to compete with ZARA, but just to test the concept. So they had actual machines in a warehouse. You put gold in, and it would test the purity and the weight, and then feed back to the smart contract and say, these tokens own this much gold now, or and so on. So, but yeah, this is still, there's almost unlimited use cases that we haven't even conceptualized yet that are going to be extremely complicated.
This is not a pitch for the BANKEX ICO, but what is the time frame for BANKEX, and when would we see sort of the first token get issued?
The pre-sale has been going on. I'm actually not on the sales side, so I don't know when they started that. The ICO, I do know, begins November 28th. I don't know the prices. I literally don't help at all with the sales, but
no, that's fine. I was more asking like just a timeline of.
Sure. So November 28th.
They're still the BANKEX team is still raising its own capital.
Sure. Yes.
And at some point they will release their software, which they have not done.
We actually most of the code we've written is on GitHub.
Oh,
so we've been in a couple of hackathons. Those were both uploaded to GitHub. There was an early car sharing use case. I think that was uploaded to GitHub. Yes, this is trying to be made open source, and BANKEX isn't really concerned that somebody will start everybody's going to tokenize assets. There's no barriers to entry. The goal, I guess, is just to be a first mover in this space, develop the expertise, run into all the difficulties before everybody else does, so we're already a little bit ahead of the game, if that makes sense.
Well, I think there's a huge benefit to having one standard for, someone to go and view a construction site and to verify, well, the documents say this is supposed to be 10 stories, but I only count 8 floors.
Sure. Yep.
And you look like you're capped off, so, what's going on? Oh yeah, we're pocketing the rest of the money, we all own Lamborghinis now, isn't it great? There's a need for that verification, and we don't really want to have 1,000 forms and 1,000 ways of digitally signing those things.
Right, exactly.
For smart contracts. Eventually it'd be nice to have like 1 or 2, and we have this, and it has a BANKEX signature on it.
Yeah, we're super excited about the So we really think so this is sort of, we don't have any use cases for this yet, so I didn't include it in the slides, but we're really excited for the potential for developing countries to utilize this. So like, right now you wouldn't send money to somebody in Somalia to do something because there would be no way to track that what you're doing.
Right.
It could just be buying cars, like you referenced. So one example that we want to do just on our own is targeted giving. So like for drinking water in Africa, you can actually, so someone would build a filtration plant and it distributes water, it tracks how much is distributed, and the water can be obtained using these tokens. So a lot of people have mobile phones there. So in this case, there'd be no waste where you send it to an organization and then they give you a report at the end of the year that says we used 69% of your money towards the end services. Right. It would literally be like, you're sending this to a specific village and they now have water from your money. They're building this plant with the money. So, but yeah, there's almost unlimited logistics. Smart pallets just, so if you want to pay for inventory on delivery, when it gets there, somebody signs their signature saying it's the right inventory. Yeah. The pallet hits the right coordinates, tracked by GPS, and then it feeds back to the smart contract saying, pay the Bitcoin to the distributor, pay it to the supplier. So yeah, I just go on and on with random examples.
In terms of like, oh, let's have a smart contract that verifies that something has arrived. That would seem like more of a really narrowly defined smart contract, as opposed to issuing a security that might represent an entire mine.
Sure.
Where does BANKEX see like most of their adoption coming from? Is it going to be sort of, oh yeah, we issue a bunch of contracts every time stuff leaves our factory, or we own 10 factories and the actual 10 factories are governed by one large smart contract? It's more like a master limited partnership that you might see in the US.
So the latter example is definitely where BANKEX is seeing the most traction. Just really what people want to do is they want to issue securities for things like this mine, and just have somewhere to track, store them. They can't be stolen or frozen, and they're safe. They legally represent end ownership, and then you can transfer them, sell them if you decide to get out of the asset. So definitely more the limited partnership structures where I see this. It's just my opinion, but the ICO model seems to be where that's really exploding. Just startups want to raise money, and there's this new mechanism where anybody in the world can see your project and fund it.
Yeah.
So.
No, I think that's a really powerful. That's a super powerful concept. I was just at an investor conference for Argentina, and they were saying that 26 companies are listed on their stock exchange that have any liquidity. I think there might be maybe 100 companies that are actually listed. But you can get quotations in about 25 or 26. So just thinking through like, oh yeah, we're the 38th most liquid company in Argentina. Well, where do you want to trade that stock? Putting that stock into a token and allowing it to trade anywhere in the world that thinks that they can get liquidity for that name would seem like a more powerful idea than, sure, let's list it on the Argentine Stock Exchange, which I'm not sure I can actually access from my TD Ameritrade account, although I might be able to.
Sure, exactly. Yeah, and ICOs are really, really, really concentrated right now in brand new startup companies, but what's really going to, basically what you just referenced is really going to be where a huge shift occurs is you own a company and you need $40 million to expand, but you have revenues, you're profitable, you have like a real offering you can make, and you're in a country where you're not sure about the listing, there's a lot of corruption and rigmarole to go through.
Yeah, I think everyone was so excited about blockchain being used to fix T+3 settlements in the United States for shares of IBM, but we've been trading shares of IBM for probably almost 100 years, if not more. That doesn't seem to be really the use case that is going to get the most traction. It would seem like illiquid things that trade occasionally, or whose the investor base is not geographically close to where it trades, would be like a much easier use case. Much like I always say, like Bitcoin's a horrible way of buying a cup of coffee.
Right.
It's a really great way of sending money to a small factory in China, but a really bad way of walking into Starbucks and trying to figure out how much Bitcoin do I have in my wallet.
Yeah.
Do I need one confirm before I'm allowed to leave with my cup of coffee or not? So I think with this, I'd like to open us up to some Q&A. Looks like we have 3 questions already on our Q&A. Let me move this so Neil can see it. My first question is going to be to the audience. Is it better to watch our backs as we do this, or should we sit on the other side of the table? Or should we just turn video off? I turn it on for 2 minutes. Off. Off, okay. Kevin says off because he doesn't want to be on the screen anymore.
Yeah.
So content's only. Okay. The first question, does a blockchain-based asset verify the authenticity of an asset such as gold?
So no, you still either need, it just represents the ownership. You still either need an independent trusted party like an auditing firm or a machine so like Loomis in the Zorum example, Loomis is a reputable company that stores hard assets. They'll say, yes, this gold exists and it's safe. So no, the blockchain itself doesn't verify it. It tracks the ownership.
They can track the historical verifications that
Sure. Yep.
Okay. Another question, we need to reintroduce ourselves. So I will turn on our video so you can once again see who we are. So I'm Eric, CEO of Athena Bitcoin, and this is our guest, Neil. You can also see if we can look in that camera, I think. So we've been the two talking. So that's that question. Let's go back to the content only. And our final question in our Q&A is, why is this real estate lending app a blockchain application rather than a simple database on the web? And I think that's a great question because this could have just been an app built on a website.
Sure, yeah, so we could totally do a database just hosted on some server somewhere. The advantage of the blockchain for the real estate use case is strictly for the global liquidity. So somebody in Dubai can download, so somebody in Dubai has Ethereum, they can see these tokens, they can see that these verifications have occurred, and they can decide to buy the token, which is in Hong Kong. So if this was just between 2 banks storing documents, they definitely don't need a blockchain to just store legal documents between the 2 of them. But in this case, what the developer wants is to be able to market these, pre-sale these units to anyone, basically anyone anywhere can buy these. And they would actually have the full legal, so the guy from Dubai could actually, at the end of construction, go live in the unit if you wanted, or rent it out, or sell it to somebody else. We can't hear you, so I hope that answers your question.
Yeah, I guess you can type if you want more questions. Eddie, did you want to say something?
I would just love to be able to ask a question that I've looked at investing in a natural resource type of asset, and I've traded coal and some other natural resources in the past at AEP. What we always had problems with in the real world on assets were things like testing of quality, people, foot on the scale kind of stuff, balance of weights,
yeah.
Ancient biblical world. How does this address that, or is it the same problem we would have whether or not we were tokenizing these assets, or if we were doing it some other way?
I think, in my opinion, we're going to have the same problems. We can cryptographically sign the results of an assay, but we can still we can just as easily cryptographically sign something that's incorrect as we can something that is correct.
Could the bonds and the insurance and liability of the people who sign those could those be added to the blockchain and part of the tokenizing smart contract to add some validity that would maybe harder to gather in the real world other than through some sort of subpoena discovery process?
Yeah, I mean, there might be some way for them to attach some surety bond or something else that says that they are, accurate. But again, how do we go and audit that without doing all of the things that I'm sure that are currently done in other asset-backed securities right now, which is you need people on the ground that you can trust to go and verify things.
All right, great, thanks.
Okay, well, that seems to be all of the questions that were asked. Neil, thank you for coming into the Athena office. I hope this was educational to everyone who's been thinking about asset-backed tokens. I know we're looking forward to BANKEX, them finishing their token raise themselves, so we can start really engaging with them on issuing some tokens. So thank you everyone for joining. We are going to try to make this available online on our website within the next 24 hours, assuming that our team here at Athena knows how to do that. So again, thank you everyone, and have a pleasant day.